I've been working so hard for the last 2 years, I should have just launched a meme coin, right? Like that's kind of like the sentiment that you ultimately drive. So I think as an industry, what we all probably want are some of the best founders building their business, but then ultimately choosing to exit in token form and having a token be a part of their capital structure rather than your traditional kind of cap structure. And again, if you want that end result, then we as an industry should focus on figuring out a way to reward that type of behavior and not encourage sort of the hyper speculative side. Because we've already done that. We already built the casino. We have the greatest casino out there, right? So we don't need to build better casinos. We need to figure out a way to build market structure that rewards sort of productive things in the real world.
All right, welcome to an episode of Fully Diluted. I'm Kinji. I'm joined with Dylan. We're both enterprise analysts at Messari. We also have Pranav and Wyatt from VanEck. So very excited to kick things off. We're going to talk a little bit about tokenization, stablecoins, DePIN, and maybe some macro and major assets. But before we get started on those topics I brought up, could we get a quick introduction from each of you and maybe what your focus on is at VanEck Digital Assets?
Sure. Maybe I'll kick it off. So I've been here at the firm for a little over 2.5 years. I come from TradFi. I did about 12 years in the world of public equities and public credit, so high yield markets, as well as distressed credit markets. Been in crypto more or less since 2017, mostly investing my personal capital. Generally noticed a pretty big white space in the 2020, 2021 timeframe that a lot of intellectual capital was going into sort of pre-seed, seed, early stage focused venture investing, but most of those projects were ultimately going to exit in the liquid markets, and the liquid markets still remain largely unsophisticated at the time. There was not clear capital allocation structures and frameworks in the space, and at the same time, you needed sort of ways to get institutional capital in. So I saw this opportunity, which, being a public markets guy, thought made sense, which was really just having a strategy that focuses on picking winners in the token markets. But again, being agnostic to whether something's a token or a public equity or security, really trying to find the winners in the crypto space, having exposure to that, and then generally managing market exposure and risk around that portfolio. So started that in 2022 here at the firm. Been doing this since then. We have a pretty fantastic investment team here that helps me kind of do everything that I do. But about 18 months ago, we kind of noticed an interesting opportunity in the market, which was we were, as a team, very bullish the adoption of stablecoins because we're sitting in a bear market and we're seeing sort of the stablecoin market cap chart go up and to the right. And we said there's clearly some product market fit here. And at the same time, we saw a bunch of really high quality founders coming to us before they launched a token and asking if we would take a look at their project as an opportunity for us to back. And we didn't have a formal process or really any strategy to be doing that. So we were lucky to meet Wyatt, and I'll let Wyatt kind of share his background in a second, and then Wyatt and his partner Juan, to really focus on that opportunity set. And then we kind of really got to know them over a period of time, and they joined us last year. So at this point, I would say we generally have the full spectrum, which is we started pre-seed seed investing. And as those projects migrate and launch a liquid token, I'll take a look at that. And that's what my strategy does. We're a liquid token hedge fund strategy. And then as projects from my world maybe mature, they could be ready for an ETF and they kind of go into a passive product at the end of the day. But maybe I'll sort of kick to you, Wyatt.
Yeah. So my journey in crypto started in 2018. I was working at an investment platform and broker dealer that was we were a crowdfunding platform, but we were attempting to tokenize early stage startup equity, as well as other types of alternative assets. We were acquired by Circle in 2018. We announced it at the Security Token Conference in 2019, back when the kind of RWA terminology was actually called STOs, Security Token Offerings. And so much of what I'm doing today here at VanEck is really thanks to the journey that my partner Juan and I had at Circle. So he attempted to build products through his company called Seed Invest in the alternative asset space. And at the time, Circle had many different business lines. People might not remember this, but we owned an exchange called Poloniex. We had a brokerage app. We had a payments app that looked like Venmo on crypto rails. We were one of the larger OTC desks. We had Seed Invest. You kind of had this whole crypto capital markets ecosystem, of which USDC was kind of dropped into. USDC ended up taking off largely thanks to DeFi summer. I went from $2 to I think $33 billion of supply in a calendar year, which made us as a firm say, like, how do we start to build out and support these founders? And a lot of it was, can we invest our own capital? So we created Circle Ventures in 2021. Juan and I were the first people to work on that. And during our time there, we ended up backing many different founders, from the underlying blockchains themselves to wallet infra, on-off ramps, payments networks, DeFi protocols, and got to really watch stablecoins grow and emerge as the platform that we all know them today. We also invested in many venture funds, some of the leading funds in the space, and got to build out a really great network. So coming over to VanEck, now we have a $40 million early stage fund. And much of our focus is trying to find the protocols and the applications that we think will help or benefit from stablecoins and that underlying infrastructure, but be that kind of next wave that grows stablecoin supply.
Awesome. Appreciate that. So I guess now that we got formalities out of the way, we can kick it off, get into the fun discussion topic. I wanted to start with tokenization and RWAs. It feels like those have had a resurgence in narrative over the past few months. I think from my perspective, you can kind of break that into two distinct segments. So you have the tokenization of financial assets and then the tokenization of dollars, which is stablecoins. So starting with stablecoins, everyone references that chart is up only. But I think when you start breaking it down, there's like a lot of different use cases you have for stables, whether it's payments, collateral assets, store value, like savings technology. Do you think like all of those are going to grow in tandem, or is there a specific use case for stablecoins that you find the most compelling and think is going to be the main one to contribute to that up-only chart?
Happy to start. I think that they will all grow in tandem, but I think right now, like for example, stablecoins are often quoted as like, they settled $24 trillion last year, double Visa's volume. Well, that's not a very correct assumption because really you should be comparing them to like whatever the 14 quadrillion that DTC settled. And so it's really like an apples to orange comparison. I think what you're starting to see though is that those volumes are bifurcating a little bit from trading. And that is basically what stablecoins are today. They are kind of yield-seeking instruments. People are using them to buy crypto assets or buy tokenized assets. So predominantly a trading instrument. However, I think through that discovery, and this is what's really interesting about crypto and permissionless systems, is that we kind of, whether intentional or not, created this really large internet-based US dollar savings economy, where now you have all these people who want to hold this asset as a hedge to their own currency, which for those that have been in crypto long enough might remember, like that was the original Bitcoin use case. It was like, you can hold it as a hedge to your local currency and then you can spend it cheaply. Stablecoins ended up becoming that ultimate rail. And so I think it's very obvious that the kind of larger market that they will eventually attack would be something like B2B payments, which is close to 200 trillion annually. So if you look at where we are today in that world, you have companies like Stripe that privately are valued somewhere between 80 to $100 billion. They do over $1 trillion of flows each year. So they have, less than a 1% market share. And that enabled them, just those volumes alone and their valuation enabled them to buy Bridge for 1.1 billion. So I think much of that up to the right chart, it should hypothetically get much bigger as you have regulation come on board in, let's say, the next 6 months. And you can already see signs of a lot of the major payments institutions, asset managers like VanEck, be very interested in this space. And so I think that grows. That grows the whole pie, whether it's a store of value, it grows trading because there's going to be naturally interest in the downstream effects of what is the stablecoin kind of ecosystem, how does it benefit from that growth? So the underlying blockchains themselves will grow, as well as many intermediaries like issuers, market makers, exchanges, et cetera, will be knock-on effects of that. But I think like the true categories, things like B2B payments, like we are barely scratching the surface on. And that's where I, like as a venture fund, when I'm thinking 8-10 years out, those are some of the categories we want to invest in.
Just anecdotally, I think one of the things we've observed is, maybe the last 2 years, two use cases have really driven most of the growth and maybe adding a third in the recent past. The two that I've seen are people using stables as a base pair to trade crypto assets. That's been sort of the oldest and kind of primary use case. Stable coins come in, they go on exchanges, and then they're kind of used as a base pair to trade different stuff. And then that ultimately translated into people in countries outside the United States saying, I could probably have these stables in my wallet as a store of value instead of my local currency. And so you saw that take off in places like Argentina and Turkey. And people also using that as a medium of exchange, in those local economies. So, you ask why is there so much tether on Tron? You could sort of make the case that this is being used in emerging markets by people for day-to-day sort of payment activity or some percentage of that. One of the things that we've seen really take off in the past, I would say 6 months or so, are B2B international settlements. So, a merchant in Colombia wants to pay a merchant in Vietnam, having that go through stablecoin rails, especially, dollar stablecoin rails, is faster and cheaper than going through traditional banking rails for that transaction. So you're seeing sort of these very specific corridors where even America might not be involved, but settling those transactions using dollar stablecoin rails is faster and cheaper, especially because some of these stablecoin issuers have established banking relationships in those geographies where it's easy to off-ramp them. So those are the three that have really, taken off in the last couple of years, and I think that will continue to grow very fast. I think the one very clear use case that has yet to even start, and I think will start getting adopted, is really B2B payments and customer to business payments in the United States. We think a lot of that has been there's maybe two reasons why those things haven't taken off. One, the lack of regulatory clarity on whether a stablecoin is a security or not, how to deal with yield-bearing stablecoins, all these things. That's created sort of this constraint where e-commerce companies, internet companies don't want to touch stablecoins, even though it's really in their best interest to figure out how to get their customers to pay with that. So I think that will change once you get this bill done through Congress, the stablecoin legislation done through Congress. The other one has really been like a UX issue, which is, it's still multiple steps to onboard to using a stablecoin, even in the United States. It's probably just easier to get a debit card or a credit card. We think that will also change in their side of regulations. We think you'll see better wallets, maybe just potentially even enabled by the big tech companies, and sort of stablecoins being enabled in the background, but that, the customer having to figure out whether they're using, USDC, USDT or whatever, right? They're just paying, and that payment settlement is happening with stablecoins in the back. And ultimately you're chipping away at that merchant discount rate, which, is typically 2 to 3% every transaction. Bulk of that goes to the banks. You get to potentially cut that out from the banks, and you still keep Visa, MasterCard, you still keep the merchant acquirer, but maybe you reduce how much the banks get. So we think that's the third use case that will likely take off on the other side of this stablecoin legislation.
Okay, that makes sense. I'm kind of curious to dive a little deeper on the B2B payment side. So am I correct? And it sounds like it's not going to necessarily be natural, or how should I phrase it? It's not going to be organic consumer adoption where the end user, i.e. a person shopping on Shopify, demands stables. It's more the businesses will want to use stable coins and essentially push people to interact with them, maybe abstracting it away. Is that a correct way to think about it?
At least from my perspective, the cost savings really goes to the merchant, right? Right now, merchants, I think Wyatt's got a better way of framing this, but the merchant is really the one paying for your credit card rewards programs and all these other things, because they're the ones paying that merchant discount rate. So to the extent they are the cost beneficiary of adopting stablecoins, then every merchant is going to have their own novel way of incentivizing that behavior, aka encouraging you to pay with a stablecoin, or essentially enabling you to pay with a stablecoin. So I think my personal view is it's going to be merchant-led. And obviously there are intermediaries that aggregate a lot of merchants as well. And I think they can also lead that effort.
I'd agree with that. I think outside of the US, ex-US, I think stablecoins are both a platform, like a payment rail, and an asset. Whereas in the US, we have access to phenomenal banking products. And I think that is an ongoing revolution as well, thanks to folks like Robinhood and Coinbase who are really pushing that from the kind of dollar savings or treasury perspective. One click, you put your dollars in, you're earning 4.5%. That's an amazing product. So stablecoins, I think, can help kind of export those type of products. But in the US, it's less of an asset. I don't think you're going to have a customer say, I want to pay in USDT, or I have a preference to pay in USDC. I think the only case that they would have that is if they had a credit card in which they were being incentivized to want to use that currency. And it's a question of, does that ever come from the issuer? No, that probably comes from another company. Maybe they're using tokens or points or something like that to make that incentive even steeper. But the only way they'd be able to enable that is by probably sharing the underlying yield. And so this is kind of our view of where things start to get abstracted. And whether it's the merchants themselves that are pushing this, or you have companies that sit in between like Stripe that can do this. And so Stripe's already offering, USDC payments today. And I want to say it's 1.5% versus close to 3% for their core product. You can see them over time. My view is that Stripe will likely launch their own stablecoin just because they have their flows and their distribution is fully through Stripe. So they have ways to kind of verticalize that product and incentivize you even more. So maybe that number goes down, or maybe they have ways of sharing that yield back with the merchants. The key unlock is to call it something Pranav said, is when you make the flow a little bit more direct. Stripe, in a lot of these platforms today, you might have to pay to get access to your funds quicker. Stripe can enable something that feels like instant settlement. And as stablecoins, as you get stablecoin legislation, as you have banks opening up to custodying stablecoins in crypto, you could start to feel the kind of magic of off-ramping. I think ultimately the goal is you don't need to off-ramp. That's when the system works best because it feels final. You can spend in it, you can pay with it. But that's been a huge blocker as well, is that you have to pay additional fees to get it off the platform, which starts to question of like, is it worth it to get it on the platform? I think globally in many corridors, that is the case. There are certain corridors where that isn't the case. And there's been great debates on this with Wise versus stablecoins online, specifically in the past couple of weeks. But I think in the US, even that would be a very compelling feature. And so as a consumer, we can feel certain benefits like this today. I can go on Robinhood, upload dollars, send them using USDC, and then I can take those dollars back and RTP them or use a real-time payment method into my bank account. I think that's awesome. Like you can ping money around the world at the speed of a text message for a fraction of a penny, but I can move it back to my bank account basically for free in a second. So that type of infrastructure for businesses is really compelling. And I think you're already seeing Coinbase, Circle, a lot of the major issuers, as well as market makers try to get into that business.
Yeah, on the store of value use case, I think Kinji's pointed out that in the US, equities are the largest store of value. Could be wrong on that. Just as we've seen Bitcoin kind of be the original store of value, now might be more stable coins in these more developing markets in the global south. Do you think it could be one day equities or another type of asset that's tokenized could kind of supplant US dollar stable coins?
I certainly think so. Again, I think stablecoins, once you start to use them and you get that feel for that tokenized asset, and I like how you framed it, Kinji, because it's really tokenized cash, you inherently start looking for what's that next thing and kind of moving up the risk curve. And so a lot of the companies that we're investing in today are playing around with that. So that could be treasuries, that could be tokenized private credit or real estate, and creating net new markets for these alternative assets. But I think increasingly it's going to be the US financial system. So just in the same way that like we exported US dollar banking to the rest of the world, once you create those rails and you publish those assets, and it started with stablecoins, the next I think is going to be US equities. And Pranav and I actually have a shared investment in a company called Denari that we'll be announcing in a few weeks that enables that technology. So I think it's very important to be compliant, to be able to have the requisite licenses to facilitate that activity. But I still think over time, and we could touch on kind of the regulation I think will come out, that will enable this both in the US and outside of the US, which is really to make the blockchain the primary record of ownership and really utilize the blockchain as the preferred ledger, which in turn kind of makes the blockchain like a transfer agent itself and recording all the transactions over time, which is very different from how it works today, which is the blockchain is the secondary record of ownership. So we operate in kind of two systems at one time. And I don't think that is the ideal end state to really make tokenized assets take off, which is why you're seeing, for tokenized crypto assets, anything that involves a stablecoin, so it could be stablecoin lending or different types of tokenized lending products, you get the benefits of that system, which is, a better UX, streamlined yield back to a wallet and a global set of participants. I think we will eventually get that, but there's still a lot more wood to chop there, much of which is regulatory.
Like one of the interesting data points from my perspective is really, if you look at stock or equity ownership between different geographies among adults, it's like, 60% plus of US adults own stocks. It's much, much smaller percentages in other countries. It's higher in Europe and then it kind of declines from there, right? If you go into emerging markets, the percentage of your population owning stocks is very low. Part of that reason is those capital markets in those countries aren't great. Like, you don't have the great tech companies out in those countries. So now we figured out how to get these people access to dollars in a wallet. I think if you give the same people now access to some of the great tech companies in the US or just any company in the US really, through a variety of financial products that already exist, the thesis would be that, you could increase the financial asset ownership for these people in these countries. So, kind of think about it as a step function. The reason dollars are appealing to these people in, let's just say, Turkey or Argentina, whatever, just picking on those as examples, but those countries have high inflation, high depreciation of their currencies. The reason they want dollars is the dollar, as much as it loses its purchasing power, it's not losing its purchasing power as much as these other currencies. Well, then you could even further chip away at that purchasing power issue by giving people access to financial assets that are available in the US, that people in America own to sort of beat inflation in many ways.
That makes a lot of sense. I suppose now that we're winding up the conversation to more tokenized assets, it's interesting that It feels like some of the use cases you guys are talking about, and something I also align with, is a lot of it is traditional finance coming in and being the supply side for assets. Like there isn't necessarily shown demand that traditional finance wants to buy on-chain tokenized assets. They're more supplying it to a crypto native user base. I think the end state is we want to get to everyone having demand for the assets. Do you think that's on the horizon? Is there some unlock that's coming up, or is the foreseeable future, TradFi as the supply, crypto natives as the demand? And we're going to be in that world for a while.
So I think this can play out two different ways. I'm curious what Wyatt thinks. I don't think him and I have talked about this in the past, but one way it could play out is kind of what I said earlier, which is people outside the United States who have a cell phone and an internet connection download a wallet, get some stables, and then you bring these TradFi assets on chain and you serve it to them, and they are interested and they are buyers of those assets. That's kind of one way this could play out, where you have supply meets demand. The other way it could play out is kind of to what Vlad from Robinhood was recently talking about. I think it was on the Bankless podcast, and sort of his interest in tokenizing private companies like an OpenAI or SpaceX. And the rationale being, if today you're an American and you try to, let's just say, buy an LP interest in any of these great private companies, and the data shows that fewer and fewer companies are going public, you have that number of private unicorns is again up and to the right. The value of those is also up and to the right. Well, people historically would have had access to them if these companies got public. Now they don't. So the biggest kind of pain point there is sort of the cost element of it. If you look at SPVs of SpaceX out there in the private markets, most of them charge a lot of fees. It's layering upon layering of structuring. You ultimately don't really know if you're actually on the cap table or not, if someone's cheating you or not. There's all these issues with this private VC, growth VC market. So to the extent you can tokenize interest in those things, and you have one entity doing the diligence and then tokenizing them, then that could ultimately democratize access and then kind of open up the opportunity set to a large base of investors. So that could be the other way tokenization of assets takes off, which is it's enabling certain assets that there's clear market demand for but can't be accessed now become accessible.
I would totally agree. I think very similar to stablecoins, this probably starts ex-US, starts with the people who need it the most and feel the most pain. And so, to touch on something Pranav said, now anyone with an internet connection can get access to the US financial system and US dollar banking. That's really important. So we're already seeing this today. Like most of the companies Denari works with are either crypto companies that are looking to tap into that audience and sell them net new products because they weren't previously able to get securities on chain, or fintech applications in foreign countries. I do think that we will see, and I think Robinhood accelerated this trend, a lot of the same, distribution providers that we have today, wallets and exchanges, namely, start to move into this world because it becomes a competitive landscape really quickly. When you have Robinhood moving into crypto, kind of forces Coinbase, Binance, and everyone else to start thinking about moving into securities because that customer base really wants an all-in-one platform. Like I think a lot of people are inherently lazy. I don't know what Coinbase is doing yet, but it looks like they're moving their wallet into the brokerage app to create more of a verticalized experience that mirrors a lot of what Robinhood has already offered. And so, if you can kind of bank with these people, you can get paid in dollars, immediately deposit into, some sort of tokenized treasury as your savings account, and then, again, move up the stack and start buying stocks, ETFs, and different types of tokenized products. I think that's how this probably starts to play out. What that could lead to, though, is that same thing as stablecoins for me. I think we have 6 years of really great data. That's how long it took before a lot of major payments companies started to get very excited about this. So that could lead to TradFi kind of looking at it and going, okay, really, there are cost savings and there is demand here. But I think initially that demand is probably ex-US and crypto native and goes through many of the same service providers that we're already used to interacting with today.
Got it. So it's really like there's pent up demand for certain assets, and tokenization can unlock that demand and service them. I think that makes a lot of sense. Last question on tokenization RWAs before I let Dylan do all the DePIN talk. But there's definitely a cohort of crypto users that want to tokenize everything. Everything should be on chain. And I suppose, do you think that's true? Or is there a line that we should not cross? I'm thinking specifically it's kind of topical with Zora and tokenized content, but where do you guys draw the line on what needs to be on chain?
Wyatt, I know you had some strong opinions there. Do you want to take it?
I'll say this. The beauty and the curse of blockchains is that all of this is permissionless. And so you can bring any asset on chain. But I'm not particularly passionate about making everything tradable because I think that's a certain type of user behavior, as we've seen with meme coins. Like, it plays into the kind of the mercenary capital side of crypto. So I think we have to be careful about the market structures that we create, regardless of like what that, I believe that creators, for example, should have better access to monetizing their content. I don't know if trading them is the right way to access that, right? Like, stablecoins enable things like micropayments. Maybe that's a better way. Or stablecoins enable a global subscription payment rail. Maybe that's a better feature set. I'm not sure that that necessarily means that, like, if Mr. Beast puts out a video, that we should be trading it. I don't know if that's the type of behavior that like ultimately gets us to mass scale adoption, but curious on your thoughts, Pranav.
Yeah, I was half kidding when I said you have the stronger opinions, the two of us there. But so having been in the liquid token markets for a couple of years now, I've kind of noticed a few different problems. I'll kind of highlight one, and then sort of we can talk about why tokenizing too many things and making everything hyper speculative could hurt sort of the overall opportunity set, or sort of really where token capital markets can go. In my opinion, tokens in their kind of best form are a better capital formation tool than stocks and bonds. So they can kind of give you the ownership properties of a stock with sort of this superpower of being programmable, such that the business behind it can use that token in novel ways to grow their business. Maybe they can achieve scale faster than they normally would. It really allows for sort of experimentation around new business models. Now, like, I think there's a handful of founders, especially some in Deepin, that really have been working hard at this and trying to sort of see what's possible. But the unfortunate reality of token markets today is there's very little market structure. And so your traditional pools of capital that allocates to stocks and bonds isn't really allocating to tokens. And all that remains is really this hyper speculative retail audience. And what that ultimately means as an end result is you have a market that kind of rewards speculative assets or hyper speculative assets through sort of big market caps and big FTVs, and sort of the useful stuff doesn't really get rewarded. And where you end up with that over a period of time is a couple of founders who are building quality stuff looking around and saying, wait, I've been working so hard for the last 2 years, I should have just launched a meme coin, right? Like, that's kind of like the sentiment that you ultimately drive. So I think as an industry, what we all probably want are some of the best founders building their business, but then ultimately choosing to exit in token form and having a token be a part of their capital structure rather than your traditional kind of cap structure. And again, if you want that end result, then we as an industry should focus on figuring out a way to reward that type of behavior and not encourage sort of the hyper speculative side, because we've already done that. We already built the casino. We have the greatest casino out there, right? So we don't need to like build better casinos. We need to figure out a way to build market structure that rewards sort of productive things in the real world. So that's kind of my view on why I think generally tokenizing random content for no reason is a good or bad idea. Now, here's the thing, like, whatever I think or whatever Wyatt thinks, whatever any of us think, doesn't really matter. Like, the market's the market. It's going to decide what it wants and what it doesn't want. And everything kind of has its moment, right? And the thing we've learned through the NFT cycle as well as the meme coin cycle is the TAM for those things is pretty small. Like, it's, in the millions of people that are likely going to want to gamble a lot in a lot of size. It always goes through this hype cycle, and it ultimately dies because you run out of people that want to play that game. Same thing with tokenizing random pieces of content. I'm sure there's an audience that wants to do that gets really excited, and maybe there's a bubble around it. But ultimately, most normies don't want to be gambling on different videos and like photos and whatever, right? Like, I don't think that's what people in the world want. People don't want hyper financialized stuff. That's just my perspective. Now, the market might tell me I'm wrong, and this might become like a massive end market, so in which case don't listen to me. But I just think it's a distraction because I don't think there's a market there.
Awesome. So kind of a segue topic or question between tokenization and Deepin. So the other day I saw BlackRock estimated, I think, 68 trillion in infrastructure investments required in the US by 2040. And their CEO kind of noted that the government might not be able to fund this fully publicly of taxes and inflation, and they might have to turn to private markets. He also highlighted how tokenization can be a great way to democratize ownership of private assets, open up more access to capital. How at VanEck do you kind of see the infrastructure opportunity? And then kind of following that, what role does Deepin have to play in both funding infrastructure, whether it's making it more capital efficient or other desirable properties? And question is to either.
Go for it, Wyatt.
I was going to say, first and foremost, maybe kind of riffing off what we were just talking about, something that excites us about Deepin is that you have real companies delivering real products. The founders in the Deepin space tend to be, I would say, kind of somewhere between what you might call like the tech world or Web 2, for lack of a better name, and crypto. And so I've always been really impressed because they have to focus on fundamentals. Like that's how their business is judged. Whereas in a lot of crypto businesses, it's very much focused on narrative. And so, very early days in terms of most of these experiments. One that Pranav and I invested in together is a company called DAWN, which we can talk about, which stands for Decentralized Autonomous Wireless Networks. The founder comes from Princeton and has built this technology over the last 10 years and has built a really fundamentally great business, doing millions in annual recurring revenue. It's accessible in 10,000 homes and can actually show you why it's cheaper and better to use. That's not going to necessarily apply across all infrastructure. I think we have to be really clear about that. And you need to be discerning as an investor as to like where tokenizing things and coordinating capital and using a token to incentivize those kind of two users comes together. So I think like with anything in crypto, it's nuanced, but we're certainly really excited about specific experiments in the Deepin space. Pranav has also made several investments in his fund as well. But moreover, I think this is an opportunity to replace legacy infrastructure, give people better products, and in turn make them actual users in the network. And I think for the next group of investors coming into crypto, like you see folks like Bill Ackman, like they go to the DePIN sector first because I think it's what they actually understand. Like it's hard when you have just a very broad network approach. Everything is permissionless. Anyone can build. I think you're starting to see more specific plays, and DePIN is one of those. I think he's quoted a few projects on his timeline on Twitter in the past and spoke about the benefits of having crypto. So it's just a better means of, I think, bootstrapping an initial network. And I think alongside tokenized assets, it's a category that we think will have a ton of product market fit over the next 5 to 10 years. And interestingly, it actually can fall into many different buckets of crypto. So, there's a big AI play there. And there's investment we're working on in that category now. It could be things as well in the payments world, as well as like wireless networks like DAWN. So it has quite a lot of breadth. And I think that also makes it very interesting for us.
A simple framing that I have is Bitcoin's the first asset in crypto that established product market fit, a store of value. The next one, very clearly, are stablecoins and things around stablecoins. So I think tokenization of assets is just a sort of a byproduct of stablecoins achieving PMF. And that's an easy sort of, let's just say, category, right? If you think of everything as this aircraft carrier and things around the aircraft carrier, I think you just look at stablecoins as the aircraft carrier, and there are all these things around it that are easier to sort of say this can find PMF very quickly. So I think the stablecoin story is now purely about just, increasing the number of users because there's already a critical mass of people that are already there. So that's easier, I think. Now, everything outside of those two things, which I would say generally would be DePIN, gaming, something in social, maybe DeSci at some point, anything in this kind of AI crypto category, which might blend into some of these other things. All these are things, that entire sort of list of jargon I just kind of threw out, I don't think have established PMF, to be clear. They've all established PMF in showing they can build the supply side of their networks, right? So, you tell someone to put a box in their house and they'll get some tokens for it. Anyone's going to, a lot of people will do that, right? Better yet, they'll figure out how to put 10 boxes right next to each other so they can get more tokens, right? They'll always game these systems. But we haven't really figured out if we can scale demand. We can very easily scale supply, but not demand. And we're yet to see sort of one successful use case in any of these things, whether again in gaming or DePIN or any of these things where, again, just picking on gaming, scaling the supply would mean you kind of build some game and you sell some NFTs and in-game items to a whole bunch of people. But turns out a lot of those people are there to speculate on those in-game items. They're not actually there to play the game. So you got to create the demand for the game, right? So I think we're yet to see the demand scale in any of these situations. And in DePIN, what it looks like more and more is that the demand actually might come from the incumbents. So it's not that you're going to go try and do customer acquisition from scratch. You might go to the existing incumbents and say, actually use my DePIN network and that will save you some cost and has all these benefits for you. That's where it seems to be heading. Now, this goes back to my earlier point, which is if a great DePIN founder has to make that pitch and sale to a large Fortune 500 incumbent, the last thing that person needs is all this noise and distraction around meme coins and random content coins. Because then this person's got to go to that meeting and fight this uphill battle about crypto being just purely like the speculative casino, right? Like that's already this negative bias that the Fortune 500 company would come into that conversation with. So I think, again, it goes back to my point that let's just make it easier for these guys to establish PMF and let's focus less on the casino stuff.
I do think that should get easier over time as we have like stablecoin legislation, as we have a market structure bill. You should see, at least I'm seeing like on the very early stage venture side, more and more traditional tech talent come in and try to solve these problems. The same core themes come up again and again, which is like you're trying to reduce middlemen, cut costs, and deliver a fundamentally better product. And so in the case of Dawn, for example, like they can cut your Wi-Fi bill in half or make it 3 times less in some cases. And then you can have people become owners in the network. Like I'm sure there's a lot of people that would want to buy that product. And then you set up a node in emerging, an emerging economy where people can't afford this stuff. You could split costs across a village. Like that has real demand. People will actually buy that product. And so the token, becomes ancillary to the core product, and then it incentivizes people, makes them owners. But to Pranav's point, you're not really focusing on people that are trying to game the system, trying to go get quick wins. You're trying to play a long game. And I think that means like really focusing on the product and business first, and then launching the token later on into the business after you've already been operating for some years. In many cases, what I'm seeing is companies are choosing to launch the token much later, sometimes 3-4 years into their business, which means for me as an investor, my vesting on the token then begins really around year 3 or 4, which means I'm unlocked in sometimes year 7 or 8, fully vested and unlocked. That's healthier. It kind of looks a little bit more like a traditional venture game versus how it was in prior cycles where you let investors earn and flip the token, and you look at these portfolios and you're like, I haven't heard of half these companies, even if they returned your fund multiple times over. So the industry is, I think, maturing and focusing far more on businesses and real products.
Yeah. On the topic of PMF, so I think we've seen Helium pretty significant growth lately. I think they surpassed 800K daily offload subs, 175K under Helium mobile subscription signups. And obviously you guys have invested in Dawn, which is also an adjacent kind of telecom wireless space. Just like looking more broadly at Deepin, where do you see the most potential or opportunity for Deepins, whether that's more in the telecom, decentralized wireless subsector, or energy, or any other parts of Deepin? How have you kind of thought about that so far?
Yeah, I'm more recently kind of as part of the AI boom, something we've been tracking for a long time, or is the idea of these compute networks and having compute really thought of as an asset, as a commodity. I think we've seen cracks at this. It comes back to the traditional problem of supply and demand, and it's generally crypto is very good at creating supply but not creating demand. But we could be in this world where, again, in the not too distant future, crypto, for all intents and purposes, is legal in the United States, and you start to see the proliferation of these tokenized assets. There's one asset that you probably want to own today. It's compute. And that, whether or not that becomes a scarce asset over time, I don't know. But you could think of, one way in which I see this emerging is like, in DeFi, we have these vault type products where people supply liquidity or they kind of become LPs in order to earn yield or kind of finance these lending markets, for example. There's many such cases. This is what I kind of call like the evolution of the tokenized private credit fund. This exists today in the real world. You kind of have to eat glass to get into these funds. It's typically like there's a minimum purchase requirement. Maybe you have to be a qualified purchaser or qualified business, which means you need to have a deep balance sheet, sometimes to the tune of like $25 million. And now this is accessible to anyone, anywhere, all over the world. And blockchains are really good at coordinating economic activity. And so you could see the coordination of compute happening on blockchains, and you could, help lend into that ecosystem or become an LP in that ecosystem across various parts of the stack. And so funds are doing this today where it's expensive to go out there and actually go buy a bunch of H100s and put together a data center. Maybe you're a small owner in a data center, or maybe you help finance a deal that allows them to lease H100s for a set period of time. So those are things I'm super excited about. We've seen examples of this in the market today with the likes of like a Cash and IONET. So I love that like once you bring these things on crypto rails or kind of publish them to crypto rails, you can start to create all sorts of net new tokenized products. I think the start again probably starts off more in the crypto world. And stablecoin users in terms of like who finances these things, but eventually they could become very large marketplaces.
The other thing I would add from like our kind of vantage point is I'm not trying to necessarily speculate on sort of new things that could be enabled by this Deepin vertical, because that's more like Wyatt's game, Wyatt's sort of the creative mind here. I'm purely looking at the token market and I'm saying I think what are the properties should I be looking for in order to ask, is this going to be a successful Deepin investment or not? Now, to be clear, I don't think Deepin as a category has really worked, right? I think it's kind of generally been an underperformer for most people for a very long period of time. I think the property that I think I care about are finding networks where you don't have to emit a ton of tokens to establish supply while looking to create demand. So you want to find networks where you can establish product market fit from both the supply and demand side in let's just say a small petri dish type environment, and then prove that it works in that little environment, and then you can kind of scale from that point on, rather than having to build sort of like a nationwide or global network of something before you can say that there's real demand. That's the one sort of thing we liked about Dawn, was that there was already an existing business that was doing what they're doing without a token, and the token could really just be an accelerant to their underlying business while enabling other things. And it's one of those things theoretically where you can prove that the system works in smaller environments and then kind of scale from there. You don't have to sort of spend all this, because tokens are ultimately in these Deepin networks like the customer acquisition tool for the supply side. And so what would be terrible is you have to spend, several years worth of tokens building supply and to only realize, oh, wait, I scaled the supply of the wrong asset, not the right asset. So
that's a great point. And actually, I remember we were doing the Dawn investment, like that word came up, is like, we're using the token to pour fuel in the fire because there was already a fire. Much of crypto, to Pranav's point, uses the token initially as a way to bootstrap. I think it's much better if you can bootstrap without it. And the next generation of businesses we're seeing are doing that, where they're creating supply and demand, building up their business. It's a slower approach to market, but it means that when they ultimately do launch a token, they're launching it into an existing ecosystem that actually can scale much faster as a result, versus having the token, like Chris Dixon writes about this all the time. It is a really novel bootstrapping method, but it's very hard to do when there's like 100,000 tokens and you have, an exhausted retail audience to participate. You need to focus on trying to build the product, I think, and then using the token to scale.
Yeah. Last question on Deepin. Kind of more on the TradFi side. I think you mentioned Bill Ackman, when he kind of comes to crypto, he goes to Deepin first because it's something you can understand more intuitively. If we see Deepin get product market fit, do we think Deepin could become kind of a major vector for TradFi to get into crypto?
I think so, but I'm not sure that they'll ever use the word Deepin, and I'm not sure they'll ever use the word DeFi or RWAs or a lot of our popular acronyms. And I think that's just because, again, even that kind of tokenized compute example, like it's Deepin, it's DeFi. So generally when Pranav and I just went to Dallas and talked to a bunch of investors, try to kind of meet them where they are. And I think that's where we cross the chasm, so to speak, from a crypto marketing perspective of a lot of these, most people in the world, they come from the traditional system. And so when you're introducing a new technology, I think it's more about the business and the use cases. Dawn being a great example, everybody gets that. Everybody has a Wi-Fi provider and can understand how to build network effects around that business. Something that I feel like I could explain to my parents and they would get it. But if I start using things like Deepin or even getting into the specifics of blockchains, I think you often lose people. So I absolutely think Deepin is a great example, but again, I'm not sure it'll necessarily be categorized that way, at least in the short term.
I think we can zoom out for a second and just sort of think about how money is allocated by the TradFi people, right? There's been this great growth in passive investing in the last decade or so. Money's gone away from active because everyone's realizing I don't need to pay a manager 2 and 20. I can just buy a low-cost ETF and get better, let's just say, net returns over the long run doing that. As you look at that and you kind of look at what are the largest ETFs on the market, on the equity market, it's basically the S&P 500 products. And so anything that looks like the S&P 500. And part of the reason is the S&P 500 has a very specific selection criteria that allows companies to get included in an index and then get excluded in the index or removed from the index. And then ultimately market cap weights it and then kind of rebalances over a period of time. And it turns out that's a pretty reasonable way to, sort of compound your money over time. And so that's what sort of the large pool of TradFi capital does, which is it buys a bunch of ETFs, right? When a new thing comes up, it kind of looks for an ETF to express a broad theme. So for example, when AI as a category really started to take people's attention after sort of that ChatGPT moment in 22, we as a firm are lucky to have one of the largest semiconductor ETFs in the market called SMH, and you can look at the AUM of SMH over the last couple of years. Because, the TradFi money woke up and said, oh, I need some AI exposure, and they look for some ETF to kind of get that through. So similarly, I kind of think of crypto that way, which is there's going to be a moment, it's kind of happening as we speak, but it's going to happen more so in the next 18, 24 months. Sort of TradFi says, I need crypto exposure. And the thing they're going to look for, I think, are sort of these multi-token ETFs that have a criteria set more or less that looks like an S&P, which is maybe it has to be a fee generating token, a certain type of properties on sort of the token distribution, where it's not concentrated in the hands of like two guys or something. And then ultimately you take a basket of that and you market cap weight it, right? A product like that is what's going to be interesting to I think, the TradFi audience over sort of the medium term. And so when we talk to founders of token projects or even pre-token, what I tell people is like, if you think the end state of this ETF end market are these multi-token ETFs with a certain set of criteria, the question these founders should be asking is, what do I need to do with my project to ultimately meet that criteria to get included in these types of indices, such that when the money comes in from TradFi, it ultimately ends up, coming into my project.
Awesome. We're at 2:00 now. I would love to ask one more question on base layers, but if you guys have a hard stop, let me know. We can cut it now.
Wyatt loves talking about base layers.
All right, sweet. I'll take a swing then. Kind of to wrap us up here, I have one question on base layers, execution environments. I think VanEck Digital Assets kind of came on everyone's radar in a big way during the Solana thesis back in 2023. And to me, the thesis around that whole trade, not just from VanEck perspective, is just this is a more performant blockchain. The price isn't really reflecting that right now. And if you fast forward today, so that seems to have played out both from a product perspective and a price perspective. But I think if you look at the landscape currently, we see Solana as a very performant chain. Base is starting to signal that they're going to really focus on performance. We have MegaETH coming down the line, which is also going to be performant. And it feels like performance is becoming table stakes. So with it having previously been the main point of differentiation and potentially being commoditized in the future, how do you guys think about like the future of base layers? How do you allocate there? What's going to pick the winners if it's not just how many transactions can I get through?
I'll give my quick 2 cents because this is not an area that I actively invest in, but I agree with your analysis, which is I think we have an abundance of cheap block space and therefore it's already become commoditized. I really think of blockchains as like a sum of their parts. Those parts are often the companies and people that are building unique products that are consuming that block space. It very similar to what happened with AI, where you had this massive capital infusion and inference costs dropped like close to 90% in just under 2 years. Like you could see the same thing in crypto in the coming 5+ years as crypto starts to go mainstream. I think the other trend that you're seeing during the same time is that distribution is king, and whoever owns the distribution will likely verticalize. And that was kind of the L2 thesis, which ultimately has hurt ETH from a price perspective. And so I think there will definitely be winners at the base layer, but I think it's unclear how that unfolds. Like, so we talked about this with stablecoins too. Like, you're starting to see a lot of the issuers begin to white label their solutions. You've already seen blockchains start to white label their solutions in the form of L2s. And so does it become a collection of kind of verticalized ledgers that talk to each other, or are there a few kind of power law winners like Solana? My view is that it's still too early to tell, but there are certainly some emerging winners. I think the way that they interact with startups today is really as a distribution center. So they're not just like a tech layer. It's like, how can I go to market on Solana and what user base is there to receive and consume my product? That same question might be asked of Base, but it might be a completely different set of expectations when it comes to the user. So still super, super early, but I think a lot of that is because like the huge participants, the rest of the world, the businesses, the institutions that would use this just are not using this technology yet. So my guess is the landscape will change dramatically. And therefore, like, the investment thesis should change dramatically over time as well.
One of the set of charts that I shared with some folks maybe a month and a half ago, which I think is kind of relevant here as well, is if you kind of zoom out, start at, say, 2020, and then till now, take all the L1s, L2s, add all the fees they've earned on a monthly basis, and then kind of look at that chart. One thing you'll see is the aggregate amount of fees earned by L1s and L2s, including Solana and everyone else, right? The entire sort of, let's just say, blockchain space. That number is lower today, last month, even in January, than it was at the peak of 21 and 22. So peak of 21, 22, ETH was earning all these fees. Solana was not really earning much fees. Nothing else was earning much fees. But that total number was far bigger than the fees that are being earned by these blockchains a couple months ago. At the same time, if you look at the composition 70% plus of that has become Solana, right? Of the smaller amount of fees being earned today. But then you look at the other side of it, which is fees earned by applications. That aggregate number is greater now than it was last cycle. So what that shows you is you cut fees and you increase throughput, you enable applications, and ultimately applications will make most of that money. And even then, you can look at the applications making all the money, and you've seen a very clear shift, which is fees are being generated by high velocity applications, i.e. trading applications, than very simple things like borrow and lend. So essentially, you cut fees and increase throughput, high velocity applications kind of scale up or grow. When I think about that, I say, okay, if I want to make a bet on a new blockchain or a different blockchain, I need to ask what's the vector by which it increases application activity even further that is not being currently enabled by Solana. And everything to me at this moment seems marginal. Like, it's like, I don't think anything like so the reason this sort of thing with Solana and Ethereum, all these things played out the last couple of years was because Solana was so much faster and cheaper for the end user that brought in a new use case. In this case, it was, to be clear, pump fund and everything around meme coin trading that brought in net new users through like a moonshot type application that wouldn't have come to crypto before. So that was really what's enabled. So again, I go back to, okay, whenever someone pitches me a new L1 or whatever, I generally ask, what are they enabling that existing players aren't that don't have, that will enable the equivalent of a pump fund in the future, a whole new thing that none of us can think about. Until I have a great answer on that or see a great answer on that, our default is to generally stick with the incumbents. Now, all that said, I think where we're heading here is the applications that are now going to leverage these blockchains are going to be more the players that already have distribution. So the applications like a pump fund had to establish distribution, right? They had to go out there and get users. I think the future applications that leverage blockchains will already have users. They're more or less kind of rip and replacing their infrastructure. It's kind of like that stupid DeFi mode thesis, which actually makes sense, which is, these fintech companies will be fintech and then DeFi in the back type thing. I think we'll actually see that. And the choices these players with distribution make will be a good leading indicator on who the winners are. So when someone's like MegaETH, it's going to be awesome, I'm like, show me who's going to use MegaETH, and then I will believe it.
Fair enough. I think that's a perfect answer. Kind of, can you enable a new use case that hasn't worked or are uniquely designed to steal a use case from an incumbent? That's kind of the only way it becomes investable.
You summarized it way better than me. I said like 2 minutes worth of stuff and you just nailed it.
Or even simpler, like, distribution is king. If you have distribution, people will consume your block space, right? So can you go out there and get it? I think that's going to be the next race.
Perfect. I think that's a good spot to wrap up. So thanks to the two of you for hopping on, and hopefully we'll chat soon.
Thanks guys.
Thanks for coming.